Hey guys, so this is going to be the ultimate course to investing in the stock market for complete beginners. I highly recommend watching it from beginning to end. We're going to be covering investing versus speculation, index funds, valuation metrics like the PE ratio, and more. Also guys, I have nothing for you to click. There is no affiliate, no sponsor, no pitch. This is what I call 100% straight value, so let's dive right in. So let's cover now what is a stock. This circle right here is going to represent a company. We're just going to call this company A. And let's say, for example, there were 4 shares of company A that existed. You would look at it like this. It would be a pie or pizza, for example, broken up into 4 equal sections. Now, this is not how the stock market typically works because there's a heck of a lot more than 4 shares. In fact, there's usually millions of them, if not billions of shares in some cases. So you just have to picture every one of those shares breaking up these pieces into smaller and smaller components, but every single one of these pieces being an equal size based on the number of total shares. Now, the share count can be increased through a share offering, and this is one of the ways that a company can continue to raise money as they are growing. And that can be problematic for investors because let's say there was, for example, 300 million shares of a company that existed, and they were all broken up into little fragments. Imagine 300 million little chunks like that. But then let's say, for example, the company decides to sell an additional 30 million shares with an at-the-market offering. Well, all of a sudden, those 30 million shares are going to be coming out of this in terms of everybody's piece becoming a little bit smaller, owning a smaller portion of that company. Because let's say, for example, if you owned 100 shares, before you had 100 out of those 300 million shares, but now you still have those same 100 shares, except there's 330 million total, so you just own less of this pie. So that's what a stock is. It's a little piece of a company. It's a tiny little fragment in most cases. 1 millionth or 10 millionth of a company, for example, or even a smaller little fragment would be the equivalent of 1 share. And then in most cases, 1 share equals 1 vote. So if you have voting shares, which most companies allow shareholders to vote, but you'd want to look into that if you're doing individual stock selection, 1 share would be equivalent to 1 vote. So the more shares you have, the more vote that you have in company decisions. Now that we've talked about what a stock is, we're now going to talk more about the IPO or initial public offering. This is the very first time that a private company becomes a publicly traded company, and this is the first time the general public is able to purchase shares of this company. Looking at this here, this is the list of upcoming IPOs. I have no idea what any of these are, but the IPO volume has dropped quite a bit with the stock market having a retraction. It hasn't so much shown up in the large caps, the large companies, the S&P 500, for example, but small and mid cap or small and mid-sized companies, and we're going to talk about market cap soon, these companies have seen a significant decline in their share price as a result of many factors. But the reason why most IPO stocks are complete garbage is because the majority of these are unprofitable companies, and that means that they do not have a means of sustaining themselves without either issuing more shares or becoming profitable. And it's an extremely difficult environment right now for companies to become profitable. Now, IPO stocks are even worse than your general unprofitable companies because they don't even have any price history. The stock market is meant for price discovery, which is finding the value of a particular financial asset. And that is determined by supply and demand and the natural market mechanism. When you have an IPO stock, this is the very first time it's being traded, and the market needs to find the price. There needs to be price discovery taking place, and that generally means the price comes down. In most cases, the price comes down a lot after an IPO. And the other thing you need to understand about IPOs is this is where the big money is actually having their payday. What I mean by that is the people who invested in that private company, a lot of those shareholders are having their exit during the IPO. Retail comes in, they're going, oh my God, it's the new companies. I want to own some of this stuff. And then you have the big money dumping their shares to retail at these inflated prices in most cases. And just to prove this to you, right here we're looking at Robinhood Markets CEO Vladimir Tenev, and this was a transaction from back in 2021, shortly after they IPO'd. Now, I have no idea how significant this share count was in terms of his total position, but he sold off 1.25 million shares of Hood July 28th, 2021 at an average price of $36.40 a share. Well, sure enough, Robinhood is now trading at $10 a share. We're talking more than 60 or 70% below where this individual sold a huge block of shares. If we look at Robinhood over the last 5 years, they obviously had a little bit of a run up after their IPO. But like we said, the founder here sold at $36.40 a share. If we look at the 5-year timeline here, it really only traded in that price level for a period of time in 2021 before dumping and then never seeing that price level, going all the way down to $8 a share here in 2022. What we're looking at here is a chart of the S&P 500, which is the 500 largest publicly traded companies in the United States. And this is the performance over the last 5 years. And if we take a look at the maximum horizon as well, you can see that since 2009, things have pretty much gone in an upward manner, except for what I call the flash crash of the pandemic. And then we had the post-pandemic rally, things settled down a little bit, and now we've continued this upwards trajectory. So for all intents and purposes, we've been in a bull market since 2009, really, and the market has increased around 430% in that time period. And the reason I'm showing this to you is because what you have to understand is during a bull market, prices become bullshit. And that is because people are not caring about valuations, and then the prices of these assets climb higher and higher, and as a result, speculative bubbles form in the market. Now, one of the most well-known was the 2008 housing market bubble, which caused this significant decline here when the stock market had a crash. It was even more significant than this, but this is showing at least a 54% drop in the S&P 500 during that time period. And that was a result of many different factors, risk piled on top of risk, speculation on top of speculation, and this ultimately led to a massive amount of wealth destruction for people. There's a few important concepts that I've thrown at you here. The first is the bull market. Yes, prices can be BS, but this is when prices of stocks are going up for a long period of time. And then the bear market is when you have a significant decline like we saw in 2008. Many would not count what happened in 2020 as a true bear market, and we also saw this during, of course, the dot-com bubble as a significant bear market that many of us will remember. Now, with a bull market, you will see greater and greater risk taking as cheap money is often entering the system. And that's because bull markets often coincide with a very cheap money environment in terms of interest rates. If you're not familiar, the Federal Reserve is in control of the federal funds rate. That's the rate at which they're loaning money to banks, and then they loan it out to you for car loans, mortgages, etc. Well, when that money is extremely cheap, a lot of money enters financial assets, such as the stock market, and that's what we saw take place right after the 2020 pandemic during the money printing era with the Federal Reserve. And this led to massive speculative bubbles forming in the market, many of which have caused retail investors, including myself, to lose tons of money in the process. I've personally made over 6 figures in the stock market as an investor, and transparently I've also lost over 6 figures in the market as a speculator. And that is why it is so crucial to understand the difference here. So here we are looking at the chart for AMC, and this is one of the most well-known speculative bubbles that has formed in the markets in the last few years. The hardest part with a speculative bubble is understanding that it's happening before you see how it ends, because when you're just seeing the beginning of it and everybody's making money, you yourself want to jump in on that bandwagon and you feel like you're missing out on a big opportunity. However, it has really just become an opportunity to lose a crap ton of money. Looking at the price here of AMC during the peak of this retail mania phase, it went up to somewhere around $59 a share, and ever since then it has just gone down. I mean, it is insane to look at how much it's gone down. Even in that period of time, you're looking at a 50% drop for those who bought at the top. You move even more further ahead for those who held on longer, you're now looking at north of a 75% loss. And at this point in time, if you go all the way out to present day, you're looking at a 90 93.99% drop. That means if you put $100 in AMC stock at the peak, you would have about $6 today left in terms of the dollar value of your investment. This is why you need to understand speculation versus investment. Speculating can wipe you out. It can make you think the stock market is a scam. The stock market is not a scam, but speculation certainly feels like it because of how fast you can lose your money. Now, a lot of people were taken aback by what happened with AMC and other meme stocks, but this is nothing new because right here we're looking at the stages in a bubble, and you can't say that this chart doesn't look a lot like that AMC chart that we just looked at. So it does seem like every time that there is a speculative bubble in the market that this time is different for one reason or another. Truth be told, the herd is always wrong. So anytime that you're following the herd and betting with the herd, you are most likely looking at a speculative bubble. Now the question becomes, are you down here in that speculative bubble during the media attention phase? Are you in the enthusiasm phase? Are you in the delusion phase? That would be entering at the very top there with AMC, for example. And that is just one example of the countless stocks that had this speculative bubble formation during the free and cheap money era of the early 2020s. And now I want to prove to you why betting on individual stocks is a losing game. It's not something you should waste your time with, and I'm going to show you what you should be doing instead. You do not need to waste your time picking stocks, reading balance sheets, doing any of that stuff in order to build significant wealth in the stock market. Now, I told you I was going to prove that stock picking is a losing strategy, so let me go ahead and do that now. This is one of the most famous examples of stock picking gone wrong, and it's a bet that Warren Buffett made over a decade ago against hedge funds, where he placed a $1 million wager, and I believe it was for charity or something like that. Warren Buffett made this bet against hedge funds, which are active stock pickers, professional stock pickers who have finance degrees and have spent their entire lives doing this. And they also have access to high-frequency trading platforms and things that retail investors just simply do not have access to. These professional traders, Warren Buffett bet against them and said that the S&P 500, the broad market, the 500 largest publicly traded companies in the US collectively would do better than this portfolio of 5 hedge funds that were actively trading in and out of the market, reallocating and doing all of these complicated strategies. Here's what the results were. Over that 10-year time frame during which the bet was taking place, the S&P 500, which was Warren Buffett's selection, returned 125.8%. Meanwhile, the portfolio of the 5 hedge funds after fees had a return of about 36%. So in one scenario, you have a near 126% return and then a 36% return with the professional active stock pickers over a decade. And what you'll find is these more active strategies can outperform, especially during a bull market. And Warren Buffett even alludes to this in this discussion. He mentions right here that the stock pickers or the hedge funds got off to a fast start, each beating the index fund in 2008. Then the roof fell in, referring to the 2008 financial crisis. What I want you to think about here is these are the world's best stock pickers. This is like the Olympics of the stock market. And if these guys cannot beat the market, what are your odds of being able to beat the stock market picking stocks from your living room couch? I'm not saying this to be offensive. I'm saying this because I wasted a lot of time trying to pick stocks, trying to beat the market. I beat the market for a period of time, and then I ended up losing money as a result of taking on too much risk. And that's the typical life cycle of a retail investor. This then leads you to realizing, oh, I just need to own the broad market. I don't need to waste my time trying to beat the market. Now we're going to talk about why invest in the stock market in the first place. Why not just leave your money sitting there in the bank, for example? Well, the primary reason why you're going to invest in anything is because you're looking to protect the buying power of your money from something called inflation. Now, as of recently, inflation has cooled off, which is a good thing to see. Inflation was a hot topic over the last few years because we saw record high inflation that we haven't seen in close to 50 years as a result of the money printing cycle of the post-pandemic era. Now, that is also what led to all of that stimulus check money and free money entering the system, creating these exasperated speculative bubbles that we just looked at with AMC, for example. But the reason why you invest is to outpace inflation, and that is something that was peaking at around 9% in June. We're now back to around 3%. But overall, this is the amount of your money that you're just losing every single year if it's sitting there in cash. Now, if you use something like a high yield savings account, you can get a decent rate today, somewhere around 4 to 5% if you're using a competitive high yield savings account, which means you can literally just plop your savings in the bank and safely outpace inflation, FDIC insured. And you should, of course, consider having an emergency fund too, which is just cash sitting there, about 6 months worth of all expenses, sitting in ideally a high yield savings, outpacing inflation and just sitting behind a wall in case of emergency. Now, beyond just outpacing inflation, the other reason people will invest is to grow their wealth. And I've built the majority of my wealth through private equity and real estate, for example, but those are illiquid and they're difficult for people to gain access to for a number of reasons. The stock market is the easiest thing for people to gain exposure to. It's 100% passive when you're doing it correctly and not following an active stock picking strategy. Now that we know that trying to make a ton of money from the next big stock, NFT, crypto, etc., is a pretty much surefire way to lose money, let's now talk about the proven wealth building strategies that actually work. And we're going to go back to Warren Buffett for this discussion and see what his advice is on investing in the stock market as an average retail investor. What we're looking at here is a compound interest calculator, and I want to show you a simple strategy that anyone can follow to become a millionaire using index funds, so long as you have enough discipline and enough time. You see, the biggest misconception about the stock market is that you have to have a big win in order to make a ton of money with it. You need to pick the next big growth stock or penny stock or whatever it may be. That is just not the case. Let me prove that to you now. Warren Buffett is a professional stock picker. He's not a hedge fund trader, but he has a investment holdings company, Berkshire Hathaway, of which he is still the CEO of this company. And his goal with this company is to own a conglomerate of different companies. And the goal over time was to beat the market, although that has not been the case in most recent years. And that is for a myriad of different reasons. But nonetheless, even though Warren Buffett is a professional stock picker himself who tries to beat the market, here is his advice on investing in the markets yourself. His recommendation is to invest in a low-fee index fund that tracks the S&P 500, giving you exposure to the 500 largest publicly traded companies in the US. And this is my favorite view of the S&P 500. This is a heat map that breaks things down by sector, and it also demonstrates how the S&P 500 is a market value weighted index. It sounds complicated, but let me explain that very simply. What that means is the size of the company in terms of their market value or market capitalization, which I'm going to show you how to calculate later, influences the amount of weight that that particular asset carries in the particular index. That means when you're investing in the S&P 500, the majority of your money goes into the largest publicly traded companies. This includes companies like Google, of course, and then you have Amazon, Tesla, Apple, Microsoft. A lot of people think the S&P 500 is a boring investment, and they don't realize that the majority of their investment is going into these absolute behemoths that have a proven track record of growth and have delivered significant returns outpacing the market. So as an investor in the S&P 500, you're a broad investor in the leading American companies, owning a little slice of this right here. And this is the strategy Warren Buffett recommends. Let me now show you how this can turn you into a millionaire. Now, according to Investopedia, the S&P 500, which is the heat map I just showed you, has had an average annualized return of around 11.88% since inception in 1957. Let's go ahead and start filling this out now, because this this is where things get really exciting. We're going to assume you're starting off with an initial investment here of $0 and that you're making a monthly contribution of $200 per month. That's $2,400 per year. Not a huge amount of money. Maybe that's the amount you're getting back in your tax return, for example. So we're not talking about an earth-shattering contribution amount. And this is going to demonstrate to you how very small amounts of money can have significant results over time when invested in the right manner. Next, we're going to fill in our interest rate, which was the 11.88%. We gathered that from Investopedia. Now we're going to put in different spans of time and take a look at the growth of this portfolio. What we're assuming here is somebody is investing $200 a month into the S&P 500, meaning that $200 is diversified across that heat map of different companies that I just showed you. Let's start off by looking at the 5-year time horizon, which I'm going to tell you is not going to be very impressive, but just wait until you see what happens at the end. At the 5-year mark, you would have $15,210.52. And the blue line here indicates your contributions, with the red line being the total value of your portfolio. In this case, you've invested a total of $12,000 and you've made about $3,000 in the markets. A lot of people would think that's pretty boring, especially seeing as that's half a decade of time. You've only made $3,000 and you've put $12,000 in. This is why a lot of people will then say, okay, maybe I need to change my approach. Maybe I need to take on more risk. All of my friends who are crypto investors, stock pickers, NFT traders, they're making more money than me. Am I doing something wrong? Well, let me show you what happens if you just stay in your lane and avoid the herd and avoid the speculation. At the 10-year mark here, we're looking at 41,873, and we can begin to see that red line there having an exponential curve that compound interest is very well known for. What you have to understand about this is that compound interest has a greater and greater effect the longer amount of time you leave your money invested, earning that rate of return. Following this strategy for 20 years, you're now looking at a portfolio value of $170,500. And just look at the exponential growth here on this chart. The crazy thing is, at this point in time, you have now invested a total of $48,000 in contributions, and you have a total of $170,000 in value, meaning you've made about $120,000 from the stock market. At the 30-year mark, you would now have over $500,000, $565,000, thanks to compound interest. Your total contributions would be $72,000, meaning that you've made almost $500,000 in profit, capital gains from the stock market. Now, we're going to talk about taxes at the very end, but I am going to have a brief discussion here shortly after we reach the $1 million mark about the potential tax implications of following a strategy like this, as well as something called a Roth IRA, which is your best option to get around those taxes. And at the 35-year mark, you could officially call yourself a millionaire because you'd have $1,007,000 and some change. As far as your total contributions, this just blows my mind. $84,000. That's the total amount of money that you've invested, and you have grown that into over $1 million of value. The cool thing about that is that you have $920,000 in capital gains. The not so cool thing is if you do this in a traditional brokerage account, you might owe 20% of that potentially to the IRS, depending on your tax bracket, which could be around $180,000, potentially $200,000 if you have a state income tax, depending on where you live. If you want to follow this strategy and then not fork over hundreds of thousands of dollars to the government in terms of taxes, let me show you the Roth IRA, which is the best option that most people have for doing this and avoiding taxes in the process. The Roth IRA is a type of retirement account you can open in the United States, and it's literally just a distinction within your brokerage account of tax classifications. They operate in the same exact manner these days as a traditional brokerage account, and you can often open a Roth IRA with your same brokerage provider. There are some limitations to how much you can contribute to the Roth IRA. For 2023, that's $6,500 a year if you are under the age of 50. And the strategy we were looking at was $200 $200 a month or $2,400 a year, well under that limit. And if you're over the age of 50, that is a $7,500 per year contribution limit. You should probably look into this Roth IRA so long as you're willing to leave your money there for a long period of time, because it's a simple tax classification that can shelter your short-term and long-term capital gains, which we're going to talk about at the end, from taxes. And if you're following a strategy like long-term index fund investing and building your wealth through compound interest and saving for retirement, you ought to be aware of these things at the beginning. Now we're going to explain market cap or market capitalization, and that's simply the total value of a publicly traded company. And there's a very simple formula to figure this out. You start off with the price per share, and then you're going to take that price per share and you're going to multiply that by the total shares outstanding. And this is going to give you your total market cap or market value of this particular company. What we're going to do now is grab a stock and calculate these numbers ourselves using these figures. And we're just going to look at Ford stock, seeing as they have a smaller market cap. It's going to be easier numbers for us. Let's start by grabbing the current share price for Ford. Ford is currently trading at a share price of $11.92 per share. So we're going to go ahead and write that in over here. And then as far as shares outstanding, Ford has quite a few of those slices of that pizza or that pie that we showed you. In fact, they have 4,041,000,000. So let me write that number out here. If we simply take the $11.92 share price and multiply it by the total shares outstanding of just over 4 billion, it's going to give us the total market cap or market value of Ford. Let me go ahead and do that in my calculator now. And as a result, we have just over 48 billion. It's 48.17 billion. So we're going to write that over here. And that's how you calculate market cap or the total market value of a publicly traded company. Now, you're not going to have to do this calculation yourself, as you can look at the market cap of a stock using Google or any brokerage platform. But this is where that equation comes from and how it relates back to those individual shares. Understanding the market cap of a company is very important, because this will help you to understand if this is a large cap, mega cap potentially, or is it a mid cap, small cap stock. So let me draw something out here that's going to help us with understanding that delineation. Let's start off with the mega cap stocks. These are the absolute behemoths of the stock market, and these are companies that typically have a value of $100 billion, and also it could be a company with $1 trillion or larger market cap in this day and age. After that, we have large cap stocks, and this is companies in the range of 10 billion to 100 billion. Pretty much at the 100 billion mark, that's where you get into mega cap territory. So looking at Ford here, for example, at a 48, they would fall into the large cap category for stocks. After that, you have mid cap, which is usually a range of $2 billion to $10 billion. And these are going to be smaller emerging growth companies. Oftentimes, these mid cap stocks are unprofitable companies that are looking to grow rapidly and then become profitable. And then finally, you have small cap stocks. This is usually anything from $100 million to that $2 billion figure. Now, you will find stocks in that sub $100 million category. These are typically penny stocks. Oftentimes, these are not even on the NASDAQ or New York Stock Exchange, which are the major exchanges. These are just places that stocks trade. And in the US, the New York Stock Exchange and NASDAQ are the two most popular, but there are less desirable exchanges, the over-the-counter markets, where you can find penny stocks and micro-cap stocks with, $5-10 million market caps. But even in this small cap category, most of what you're going to find here is speculative junk. And again, individual stock selection is just not something I would recommend to a beginner or really anybody, unless you want to go work on Wall Street and become a hedge fund manager yourself or something like that. I found this visual here to be quite interesting. It shows market capitalization of different companies over time. And this is interesting because it changes based on technology, innovation, and all sorts of different factors like that. For example, back in 1999, during the dot-com bubble, Microsoft was the most valuable company, and it had a $583 billion value. However, post-dot-com bubble, GE was the most valuable company, and now GE is a pretty undesirable stock that their market cap is nowhere near that at this point in time, as industrials and manufacturing and things like that are just not a major component of today's economy. Today, it's all about data, technology, AI, things like that. The next thing I'm going to cover is categories of stocks, and this again is based on where a company is at in their business cycle in terms of whether they're still rapidly growing or are they instead maybe a well-established company that's just looking to continue their operations. We're going to start with growth stocks, and we're looking over on Morningstar, and this particular stock here is Meta Platforms Inc., formerly Facebook stock. With a growth stock, as the name suggests, the company's main focus is on growing as fast as possible and capturing as much market share as possible in their particular industry. What they're doing with profits is dumping it back into growth for the most part. So as a result, they're not typically paying dividends, or if they do pay a dividend, it's a very small yield compared to an income play, for example. Now that segues the conversation into income or dividend stocks, and these are companies that are already very well established, meaning that they're not really growing much or possibly at all, but they're often consistent dividend payers, sharing a portion of their profits. An example of this is AT&T stock, and as you can see here, their current dividend yield is around 7%, which is very high. But if we take a look at the share price and we open it up to the last 5 years, we can see that it's been on a significant decline, going from a high of somewhere around $28 a share down to $14. Even though that dividend is high, if you bought AT&T stock at the wrong time, you could be down 50% even on a well-established company like that, which is why individual stock selection is just not recommended. The other category is value stocks, and it's difficult to determine what exactly these are because it's subjective, as value often is. Value investing is something that really doesn't work anymore. It's what Warren Buffett did back in the 80s and 90s before the market was as efficient as it is now. In today's modern age, it's nearly impossible to find any price discrepancies in the market, and that's exactly what people like Warren Buffett would do, is trying to find a hidden gem where it's been sold off more than it should be, or there's an opportunity for arbitrage, for example, that somebody might not be seeing. But today, with algorithms and everything like that, you're really not able to find these opportunities. But some might argue, for example, okay, perhaps this is a value play. Currently, AT&T is trading at a price to sales ratio of 0.86, which means that they're trading for less than their total revenue coming in annually, which is pretty wild. But again, there's reasons behind this, and this is often like the dog at the pound that's been there forever and people don't want it, or maybe it's that last piece of cake sitting there at the diner, that's been getting sneezed on all day by everybody taking it out. Maybe it's an opportunity, but there's probably a reason that it's so cheap, or the last one sitting there, for example. Now, we talked about this briefly looking at the S&P 500 heat map, as that was broken down by sectors, and then within that you have particular industries. But this is just helpful to get a general overview of how the entire world or global economy is broken down, and this is the global industry classification standard. We're over on the Motley Fool for reference, and these are the 11 recognized sectors or segments of the world economy. You have energy, materials, industrials, utilities, healthcare, financials, consumer discretionary, consumer staples, information technology, communication services, and real estate. Now, within these sectors, you're going to have cyclical and then defensive ones, and it can also be specific to industries, which are just a smaller component of a sector. Defensive industries will see a very consistent amount of spending regardless of what the underlying economy is doing. An example of that could be utilities. Whether or not we're in a good economy or a bad economy, most people are still paying their water bill, their utility bill, etc., making these very consistent investments. But during a bull market, the cyclical industries are going to outperform. These are ones that are going to see varied level of spending that's often based on how much money people have in their pockets. And this is things like hotels, restaurants, dining, or for example, consumer discretionary would be a major sector here. Things things like getting a new car, all of these are optional things that we often will eliminate from our lives in the bad times. Now, when you invest in a diversified manner, you're owning all sorts of different companies that are scattered across all of these different sectors and industries, giving you broad exposure to all of this. And the benefit to that is during those hard times, when those cyclical industries are facing declining sales and it's impacting their share price, those defensive industries are holding up the portfolio and allowing you to ride things out. Those are the ones spitting out those dividends, allowing for that reinvestment in oftentimes buying those shares at a much lower price, because during a bear market, prices of stocks are dropping significantly. So reinvesting those dividends means you're buying things at a much cheaper price than you may have previously. Now, we talked about this briefly at the beginning with our discussion on Warren Buffett's bet against the hedge funds and how he picked a Vanguard S&P 500 index fund. We're now going to explore the exact financial product Warren Buffett used in his bet against the active hedge fund stock pickers, which beat them by a landslide. This right here is the Vanguard 500 index fund, and an index fund is simply a type of mutual fund that aims to track an underlying index as closely as possible, and in this case, that index is the S&P 500, which is that exact heat map I showed you at the beginning of this video. Now, index funds are sort of an old school investment in this day and age, and that's thanks to another popular financial product called the ETF, which was also popularized by Vanguard. This index fund is really credited to John Bogle, and we just did a full video on Vanguard index funds for beginners. I'll put a card in the corner for later, as you should definitely check that out if you're looking to follow this recommended passive investing strategy instead of trying to become an active stock picker. These are a bit more limited here because the minimum investment is $3,000, but that's because this is a fund type investment. They're also less liquid, which means it's a little bit more difficult to get in and out of them, as you can often only sell at a set time frame during the day. We're going to now pivot the discussion into ETFs, which is simply taking a fund like this, breaking it up into shares, and then allowing those shares to trade on the stock market. That is the exchange traded fund. And we then arrive at VOO, which is the answer to all of your problems in terms of diversified investing. Now, again, later we're going to talk about portfolio allocation. As you get older, you do want to allocate more money into things like bonds, as VOO, even as it stands, is still a pretty aggressive or risky investment, as it's 100% stocks, and it includes a decent amount of growth stocks in that mix. If we take a look at this style box right here, you're going to come across this quite a bit on various investment research sites, and this is a really helpful visual for understanding the risk of a particular asset. So looking at the VOO example here, the S&P 500, as far as whether or not this is a value or growth play, it sits right in the middle as a blend. That's because it's a mix of these large, well-established companies that are just simply paying out a dividend and not growing that much, but also small and mid-cap companies that are on the growth side. Now, we talked about sectors earlier, and this gives you an interesting visual breakdown of how your money is broken up across this investment. So when you invest in something like the S&P 500, 8.7% of your money is in communication services, 10% is in discretionary. I'm not going to go through all of these. You have a lot of money in information technology, as that has become a core focus on today's modern economy. But this is why index funds are a popular investment, because you have built-in diversification across all of these different sectors, some of which are cyclical and some of which are defensive, allowing these things to balance out over time. And if you're curious about the holdings within the particular ETF, which you should be, that's what we have right here. We're looking at the top 10 holdings of the S&P 500. The crazy thing is, if you go out there and put $100 into VOO, or the S&P 500, about $7.50 of that is going right into Apple stock because of just how big they've become. And then $6.50 would go into Microsoft, and about $3 would go into Amazon, and then the same amount into Nvidia. You get the idea here. Because of how top heavy the market has become with these big tech leaders, a lot of your allocation goes right into Apple, Microsoft, Amazon, Nvidia, and Alphabet. Right below that, we have Tesla, and then there is Facebook, and then the other class of Alphabet shares, as they have a voting and non-voting class. If you decide to invest in the S&P 500, about 25% of your money goes right into these top 10 companies right here. And the one that blows my mind once again is that about 7.5 cents of every dollar you invest simply goes right into Apple stock because of how dominant that company has become in today's world. The next concept I want to cover is dollar cost averaging. And this goes hand in hand with investing in ETFs because there's a certain approach you want to follow when investing your money. In the earlier example showing compound interest, we talked about putting $200 into the stock market every single month over the long run, and that is dollar cost averaging. What that means is trickling your money into an asset over time at routine intervals instead of dumping all of your money in at once. Let's say, for example, you had $10,000 and you were looking to invest it in the stock market. The best approach would be to invest that over the course of a year, for example, at routine intervals versus dumping that 10 grand in at one point in time. And let me show you why that is. Once again, we're looking at the S&P 500 and we can see how it goes down, it goes up, it goes down, it goes up, it goes down, and it's been going up for a little while, but now it's going back down, for example. If you're dollar cost averaging, you're buying a little bit here, you're buying a little bit here, you're buying it here, you're buying here, and buying here. Over time, that means you're paying the market average price for those shares, meaning that you're not overpaying. And let's say you continue doing that at routine intervals. By the time you got over here, the majority of your purchasing was back here, meaning your cost basis or your average price per share is going to be quite a bit lower than where you're at over here, meaning you're probably up quite a bit. Whereas consider somebody else who might come into the market and say, oh, I want to invest, let me put my 10,000 in right here. And then it goes down. We've dropped, 4%. Doesn't seem like too much just yet, but on 10,000, that's still $400 that didn't need to be lost. Whereas if you were dollar cost averaging, you could simply buy more and get a better deal being able to buy more of those shares at a cheaper price than you paid prior. Now, the reason why we're looking at horse racing here is because it's the perfect analogy for understanding why you should invest in index funds or ETFs instead of trying to pick individual stocks. Picking individual stocks is a lot like betting on a horse race. It's difficult to know what horse is going to come in first, even if you have all of the statistics and the jockey information in front of you, because there's a lot of randomness at play and external factors that you have no control over that are impossible to foresee. Now, index fund investing is like betting on the outcome of the entire race, where if all of the horses do well, you make a little bit off of each horse. Now, maybe certain ones lose, but the winners will outperform those losers, and overall, you will make money. Asset allocation is essentially going back to that pie example, figuring out how much of your pie you want to put in stocks, which is equity in companies, and then how much you want to put in other investments like fixed income bonds, for example. Bonds are a debt investment, meaning that you don't have equity, but you are first in line to get paid, whereas, as we talked about earlier, the shareholders are last in line. They're less risky, and there's different types of bonds. You have corporate debt, corporate bonds, which are the riskier type. You have municipal, which is loans to local governments, and then you have treasury bonds, which is loans to the US government itself. All of those in different blends become bond portfolios, and you can easily buy index funds that encompass all of this. BND is the Vanguard Total Bond Market ETF, giving you diversified exposure to bonds, and the current yield on this is a 4.58%. These are lower risk than stocks. As you get closer to that date, you're moving more and more of your money, typically in 5-year increments, over to your bond category versus having it in your stock allocation of that pie. The question becomes, how much of your money do you put in the stocks and how much of your money do you put in bonds? Well, the advice here from John Bogle himself is to put roughly your age in bonds. If you were 45 years old, for example, you'd put 45% of your money into bonds and 55% in stocks. And then maybe at the 50-year mark, that is when you would change your allocation to 50% bonds, 50% stocks. As you get older, older, it's like a stair step where you're getting more of your money in bonds and a little bit less in stocks incrementally. And this is just with a percentage allocation between how much money you're putting in one index fund or ETF and how much you're putting in another. If you wanted to, you could use VOO to capture the S&P 500 and BND for bond exposure and just do percentage allocations between the two. But I would definitely recommend conducting your own research on different bond ETFs out there, as there are quite a few different ones. And you may also want to consider looking at some global market ETFs just to get broader exposure than just the top 500 companies in the US, for example. Now, you might think that once you figured out your allocation, you can just set your portfolio and forget it until you have to change those numbers around every 5 years, for example. But that is not the case. And that is based on something called portfolio drift. Let's get into that now. Portfolio drift happens as a result of the assets in your portfolio behaving differently. And this is going to be the case because bonds, for example, are a much less risky environment versus stocks. What's typically going to happen is the value of the equities or stock slice in your portfolio is going to exceed the growth of the value of your bonds. And what happens as a result is you end up having more of your money than you intended to invested in stocks and not enough invested in bonds, which means you're taking on more risk than you actually intended to with your original portfolio allocation. Now, this site here has a nice visual example I found. It shows us starting off at a 60% equities or stock portfolio and a 40% fixed income or bond, for example, portfolio. So a 60-40, maybe this is a 40-year-old individual with 40% in bonds. Well, fast forward 6 months, for example, and let's say it's a bull market. Now 65% of their money is in equities or stocks with 35% in bonds. At this point in time, you'd want to sell off a little slice of those equities and then buy more of the bonds to get back to your target allocation, bringing you back to your original plan. Now, you don't want to do this all of the time. A few rules of thumb are to do this maybe once or twice a year, or people will often adjust their allocation once you're off target by 5%. But don't stress about this in terms of doing it like every week, for example. It's a much less frequent activity, but you can't, for example, just leave your portfolio sitting there for 5 years and expecting your allocations to stay where they were. Now, if you don't want to worry about reallocating whatsoever and you are investing for the long term, let's say for retirement, for example, Vanguard does offer target retirement funds which have built-in reallocating as well as built-in rebalancing. So not only are they changing the asset mix as you get older to de-risk the portfolio, they're also making sure that as the markets fluctuate, it stays within a target range. That way you're not taking on unintended risk. The way this works is you scroll down here and there are various target years for retirement, and it's all based on your birth year. You can literally come right over here and say, okay, for example, I was born in this group right here, meaning I would want the Target Retirement 2060 fund. And this is literally tailored towards a retirement in that realm of time, and it's going to continue being adjusted for that goal. And this means you can drop your money into this without worrying about allocations if you wanted a completely set it and forget it low fee approach. Now we're going to talk about the price to earnings ratio, which is really the most important financial metric that you have to understand. It allows you to determine how much you're paying for exposure to $1 of annual company earnings. When a company is trading at a high valuation, it means that you're paying an insane multiple for that dollar of company earnings. In order to calculate this, what you're going to do is take the current price per share of a particular stock, and then you're going to divide this by the EPS, or the earnings per share. Let's stick with the theme here again, looking at Ford, seeing as we already have some of these numbers figured out. As we said earlier, Ford is $11.92 per share. Now, over the last 12 months, according to Y-Charts, the Ford diluted earnings per share is $1.02. And then if we simply do the math here, taking $11.92 divided by 102, it comes out as 11.68. So I'm going to write that over here as our calculation calculated price to earnings ratio, and I'm going to double check it and see where we came in. Over on Google, it's showing 11.63. That's probably because the price per share has changed, but that means our figure here is pretty accurate. That means if you were investing in Ford stock, you would be paying $11.68 for exposure to $1 of that company's annual earnings. Now, that doesn't mean it's going in your pocket. That's just the multiple that you're paying on that company's earnings. So now that we have a good understanding of that PE ratio, I want to show you a tool here that Fidelity offers. You don't even need to have an account. All you have to do is search for Fidelity sectors and industries. So the PE ratio can be used as a comparison metric within a particular industry, compared to that industry average or compared to peers, as a way of determining if that particular stock is more or less expensive versus the whole industry or their specific competitors. For example, we're going to open up information technology and take a look at the particular industries within this sector. And as you can see, that is now broken out into communications equipment, electronics equipment, IT services, software, etc., etc. So those are all specific industries within that sector. Now, the cool thing about this tool, it shows us companies you may recognize in this particular industry, like Apple, Microsoft, Visa, Nvidia, for example. Down here, we can get the numbers we're looking for. This is the sector specific PE ratio. They have a figure for both last year as well as an estimate for the particular year that we are in. In this case, it's a PE ratio of around 39. So that means for the information technology sector, overall, investors are willing to pay $39 for exposure to $1 of company earnings annually. Now that we know the average PE is 39, let's take a look at Apple as well as Nvidia and benchmark them to the industry average to see if they're less expensive or more expensive than the average. If we take a look here, Apple comes in at a PE ratio of 29.45, so that makes this less expensive than the industry average, but that's also because Apple isn't growing as fast as they used to, and there isn't as much future growth being priced in today. And Nvidia stock is coming in at a PE ratio of 239, which is insanely high. At this point, I'm going to walk you through the process of buying a stock or ETF using Charles Schwab. Now, I'm not going to make any specific recommendations in terms of a brokerage, but I would often recommend looking at assets under management and how long the brokerage has been in business. And you'll often find you come across Charles Schwab as well as Fidelity being very solid options. But anyways, what we're going to look at here is the ETF VOO, the Vanguard S&P 500 ETF we've been talking about throughout the entire video. I'm going to search that up. I'm going to show you how you would place a buy order, and I'm going to show you the two order types that you need to be familiar with. Over here on Charles Schwab, we're going to click here and then enter the symbol, which, as we said, is VOO, and that gives us the Vanguard S&P 500 ETF. At this point, we have various information on this particular ETF. If you wanted to conduct more research on it, we have that same Morningstar style box we were looking at earlier. We saw a version of this over on the Vanguard website, and you can see where the risk profile fits. It's somewhere right in the middle, as we've talked about, where you have some mix of value, some mix of growth, so that definitely makes sense. When you're ready to buy shares, what you're going to do is click on the green buy button, and that's going to open up the Schwab order ticket over here, and we can see that we have a bid and an ask price showing up. These are the current prices on the buy side and the sell side for this Vanguard ETF, and you can see this updating every few seconds. This is important because depending on if you use a market order or a limit order, you may or may not need to reference these particular figures. By default, the action is set to buy as we selected the buy button, but if you were instead looking to sell it, you could click here and change this to sell. But we're going to go over here and go back to buy. And at this point, you would enter the quantity that you're looking to purchase. Now, Schwab and other brokerages offer fractional shares. I don't believe I have that enabled here, but you can invest dollar amounts instead of buying whole shares. And that's one of the reasons why it's even easier to do this style of investing today than it was in years prior. Next, we come up to the order type, and there's only two that I really need to cover here. The rest of these are related to more active trading strategies that really would never make sense for these applications. But we'll start with the market order as it's the easiest to understand. With the market market order, your order is going to be filled immediately at the best available market price. And that is between the instantaneous bid and ask price when your order is being filled. So it changes all of the time. It's going to go up and down by a few cents as you place your order. So if you don't care about the exact dollar value that your order is getting filled at, you just want to make sure it gets filled, the market order is great for that. And it also works in that manner on the sell side. That's the market order. But as far as the limit order goes, if we change that back over here, you can see we now have to set a limit price. And you can use this if you want your order to fill at a specific price. Right now it's set to 402.37, and that means that unless the price of VOO is 402.37 or better, the order will not execute. You can also do a limit sell order, and it will only sell at that price or better, not even a penny below it. Now I'm going to give you a quick example here of capital gains and capital losses and show you how capital losses can offset capital gains. In an ideal situation though, you don't want to have any capital losses, and those should really only arise from bad short-term trades, of which I'm hoping you're not making any, as my goal here is to convince you to become a long-term index fund investor. Let's say, for example, you had 100 shares of a company that you purchased and you bought those at $10 per share. That would be an original investment here of $1,000. Now, let's say you fast forward a year later and that same $10 per share investment is now trading at $13 per share and you still have the same 100 shares. That means your investment would now be worth $1,300. You paid $1,000 and now it's worth $1,300. Let's say you executed a sell order and that means you've made a profit here of $300. You got your original $1,000 back and you have $300 extra that you generated from the markets. That would be a capital gain. Now, for example, let's say you also bought 10 shares of a stock that was trading at $5 per share because you heard it was going to be the next hot stock and you spent $50 in the process on that particular investment. And then let's say you ended up selling it for next to nothing. Let's say you sold them for a penny a share each. Well, in that case, you would make back a total of 10 cents at the end of the day on your original investment, which means you would have a capital loss over here of $49.90. What would happen at the end of the year is if this was your total trading activity, you would look at this snapshot and say, okay, there was $300 of capital gains and then $49.90 of capital losses. What is the net capital gain? Well, you're simply going to subtract that $49.90 from the $300. And that comes out to be $250.10 being your net capital gains. And that is the dollar amount that you would pay taxes on. So that's how your losses can offset your capital gains. But again, in an ideal scenario, you shouldn't have any losses because you'd want to avoid this activity over here entirely of randomly speculating on stocks, cryptos, etc. Now that you have an understanding of capital losses versus capital gains, let's talk about the tax side of things. Now, you're going to want to consult with a tax professional regarding your specific tax situation, but we're just going to cover some of the basics in terms of short versus long-term capital gains, as you should definitely be aware of these things, especially if you're considering a long-term investing strategy. Now, here's one of the crazy things about the US tax system. It actually incentivizes long-term investing. So not only is it the best strategy in terms of what's going to work for most people, investing in a diversified manner for the long run, it's also going to have a more favorable tax treatment. If you have gains at the end of the year, meaning you've sold off stocks and your capital gains exceed any capital losses that you may have taken, and then what's left over there is your net capital gain. And that net capital gain is going to be taxed at either a short-term or long-term rate, depending on how long you held the particular asset. If you own an asset for less than 1 year, it's going to be taxed as a short-term capital gain, which will be the same tax rate as the income from your job. But if you hold on to something for greater than 1 year, you're now eligible for long-term capital gains tax treatment, which is going to be a more favorable tax rate. So for example, on short-term capital gains, I believe it caps at 37%, whereas on long-term capital gains, it caps out at around 20%. I do want to mention again, if you do all of this within a Roth IRA, you don't have to worry about short-term capital gains, long-term capital gains, or dividend taxes at all, as that's in a completely tax-sheltered account. However, you do still need to keep the restrictions in mind about the account, the main one being that you can't touch the earnings until 59.5, but you can touch those contributions if you needed to during a pinch, for example. Now, if you are curious about the balance sheet, fundamentals, and things like that, 2 years ago, I did a version of this video that was 3 hours long that gets into a lot more details about valuing stocks and all sorts of things like that. If you want to watch that, I will put a card up in the corner, as there is some valuable information there. Now, if you do want to see more videos like this, make sure you subscribe and hit that bell for future notifications. You can click below to start watching that Stock Market for Beginners longer video right now, and I hope to see you over there.